It's NY, David Perra from ICG Financial Planning. And don't forget, you too can join in the conversation. Any questions, any comments you might have, email us yourmoney@skynews.com.au, or you can even tweet us. Just use that hashtag there at the bottom of your screen. It is the very best way to make sure our guest host answers your question right here on the show. David, look, thanks very much. And happy Christmas, this Christmas
Likewise,
Eve.
James, thank you.
Your thoughts on the session? No big movements, but understandable, I suppose, in a shortened trading session.
Yeah, there was light volume today, given that it is Christmas Eve. There was a shorter trading day today. Also, considering that most people are on holidays, a lot of brokers are taking off. The fund managers have pretty much shut shop for 12. We'll look forward to 2013. So, factoring all that, I guess there is something still in the headlines and in the back, which is the fiscal cliff that is still keeping a lot of attention, and hence why a lot of us are sort of glued to this market right now, given we've got 8 days to go.
It's interesting to see utilities and the REITs in particular, the two best performers sectorally. Look, the REITs have had a pretty good year.
They have. The REITs have been probably one of the best performers year to date. Given their performance they had, if I go back from 2007, 2008, in the height of the GFC and the fall of the GFC, fall of the market, basically REITs did cop a bit of a decrease, given that a lot of them were exposed and the banks calling in their debts and so forth. A lot of them forcing to sell down assets, whether it be domestic, international assets. We saw names like such as Centro, who basically reformalised and now had the managed funds arm, now have the equity arm. So REITs have been due for a good performance, and we're seeing that, and we're starting to see that space.
Is it a space you like? I mean, a lot of the people we talk to describe it as a boring one. Like, it's not an awful lot happens, but you get the steadiness, if you like, of performance and return.
Yeah, that's a good point, James, because you do get a good income with REITs, particularly if you're holding a lot of the top players within that market, whether it be an equity or a managed fund. And traditionally, they have been known to provide a good dividend yield or quite a positive one, and you take into consideration tax-adjusted yield as well and so forth. But I like the space. I have been in that space, or we have been investing in that space for clients for the last 12 months or so, given that I identified that there was value in that space, given that they'd fallen so low. Perfect example is, look at Westfield when they had the break with their Westfield retail arm as well. Both of them have picked up significantly. So given that there will still be positivity in the market next year, watch this space with the REITs as well.
Look, to the biggest performance, as we saw in terms of index weight, CBA and Telstra doing pretty well. Look, good years in general year to date for those two stocks.
They are
incredible standouts.
Touching on Telstra, at the start of the year we were looking at Telstra with a 3 in front of it at $3.30. Dividend yield on Telstra was close to double digit. We have seen it perform quite handsomely as a result, and we're above 4 at the $4.30 mark. The question that I've been getting from a lot of clients is, do you see this performance carrying on to the next year? Given that yield and the RBA and the central banks are starting to scale down, I guess, deposit rates and cash rates, there probably still will be that need to chase yields as investors want to look for an income. Moving to CBA.
So it can go higher, do you think, Telstra?
Potentially, if we see the banks decrease the cash rate, and there is talk that the cash rate within Australia will go to possibly 2 to 2.5%. If we do see